Our next speaker will be Anna Kuykendall, and she's going to talk about loans and distributions. And Anna, there she goes. She's all ready. So Anna, the floor is yours.
Can you hear me? And my screen's sharing well, right?
Yeah, yes, you're all set, Anna. Yes.
Okay. Okay.
Looks good.
Well, Kim and Dawn made it look easy. So, okay. Good afternoon, everyone. Thank you, Elke. My name is Anna Kuykendall. I am a manager here at Definiti. I work very closely with our internal withdrawal processing team that is primarily focused on defined contribution plan requests in coordination with most of our record-keeping platforms that you all work with. This presentation is going to go over some basic information regarding distributions and loans from qualified plans. Keep in mind that it is at the plan sponsor at your discretion what types of withdrawals you want to allow in your plan. Although withdrawals from retirement plans can appear to be a very simple ask, they are not always a simple request. There is a lot of behind the scenes information that must be confirmed before liquidating money from your plan. Okay, so the difference in distribution. Retirement plan money is held in a trust account. This does not operate the same as a bank account. So you cannot log in, request a withdrawal, and it immediately be funded into a bank account. Because of the difference, withdrawals from a retirement plan require multiple party involvement and typically take more time to process. Typically, participants will submit a request for a withdrawal directly to the asset custodian that is holding the trust asset, or to you all as the plan sponsor. These requests are then reviewed for accuracy by Definiti and sent to the plan sponsor for their final approval before being processed. Withdrawals initiated by plan participants may be in the forms of loans, hardships, in-service distributions, or most commonly upon termination of employment. Withdrawals that are initiated by plan sponsors may be in the form of corrective distributions or refunds due to failed testing or administrative errors, or involuntary distributions. Involuntary distributions are also called force outs, commonly from retirement plans, and those are surrounding terminated participants that do not submit a distribution election. Distributions from retirement plans are a taxable event, and a 1099-R is issued to the participant reporting the transaction and any taxable information. Loans are not a taxable event until they go into default, at which time the money that a participant borrows must be claimed as income. Pooled or self-directed brokerage account. The process and timing for a withdrawal is dependent on whether the money is held in a pooled trust, a self-directed brokerage account, or on a participant-directed record-keeping platform. In cases where the plan assets are held in a pooled trust, periodic accounting, also referred to as a valuation, will need to be completed to determine a participant's vested balance before funds can be distributed to terminated participants. The plan documents typically dictate the timing of the valuations, whether they are quarterly, semi-annual, or annual. Because of the timing of the timing of payments to participants may be restricted and requests can take some time to complete. So if you have a plan participant that requests a termination distribution during the year and your plan is only valued on an annual basis, typically there are distribution restriction timing for participants that whereby they cannot take a distribution until the following plan year. Pooled trusts are always established for defined benefit and cash balance plans and are sometimes established for defined contribution plans. Self-directed brokerage and participant-directed accounts that are held on a record-keeping platform are only permitted for defined contribution plans. In some self-directed brokerage accounts, assets are transferred out of the name of the plan and into an IRA with the same asset custodian as an in-kind transfer. When these occur, a 1099-R tax record still must be prepared, showing the rollover out of the retirement plan and into the IRA. In partnership with PenCheck, Definiti can assist you in preparing and issuing these tax documents. How long does it take? This is always the magic or the most common question. Account balances held on a participant-directed record-keeping platform typically take about 7 to 10 days to process, assuming everything is in good order. Most of the time, that 7 to 10 days is from the date that the participant has requested the withdrawal until the date that the money has been liquidated from the plan. Electronic requests for plans that are on a record-keeping platform are more often received in good order and turned around within a more reasonable time frame. The most common not in good order items that we come across are incomplete forms, missing dates of termination, verification of current year hours for calculation purposes, and then holding on to distributions until a final payment is made into the plan for that request to be processed. Most of our major record-keeping platforms that we work with allow for plan participants to initiate withdrawal requests online. Many of those same record keepers will also allow the plan sponsors or us as the TPA to initiate withdrawals online for participants that are completing a paper request. Paper and form requests and withdrawals processed from pooled and brokerage accounts require additional processing steps and approvals and generally do take a little bit longer to issue the payment. Regardless of the account type or where the assets reside, the plan sponsor or trustee must always approve these withdrawals. Okay, RMDs, required minimum distributions. These are the amounts of money that must be withdrawn from an employer-sponsored retirement plan, IRAs, SEPs, simple IRAs, by owners and qualified retirement plan participants that have attained a certain age. The Secure Act recently increased the age that a participant is required to start taking these minimum distributions to age 72. This was an increase from the prior to the Secure Act from age 70 and a half, where it had kind of held steady for quite a long time. This date that required minimum distributions are required to begin is called the required beginning date. There is pending legislation that may increase this age even further for RMDs that are initiated gradually over 10 years. So you'll kind of see that age 73, and this is, again, pending legislation right now. At age 73, for participants who reach age 72 after December 31, 22, age 74 for participants who reach age 73 after December 31 of 29, and age 75 for participants who reach age 74 after December 31, 32. Although it is ultimately the responsibility of the plan participant to initiate RMDs annually, we can absolutely assist in identifying participants that are RMD eligible, and can also assist in calculating the amounts that are due to those participants, as well as provide instructions on taking those types of distributions. We do have a publication that I'm sure Elke will share at the end of this presentation in regards to these RMD regulations that are pending for you all to further reference. Quadros. These are qualified domestic relations orders. So a quadro is a judgment, a decree, or an order for a retirement plan to pay child support, alimony, or marital property to a spouse, a former spouse, a child, or another dependent of a participant within a retirement plan. Quadros must contain specific information such as the name and last known mailing address for both the participant and the alternate payees, and the amounts or percentages of the participant's benefits that are to be paid to each of the alternate payees. A quadro may not award an amount or form of benefit that is not available under the plan. So the provisions of the plan document and the forms of payment still must be followed. Quadros can be complex and generally require involvement by legal representation to prepare and obtain appropriate signatures. Payments cannot be made until a quadro has been fully executed and all criteria is met in order to be qualified. The plan sponsor, the participant, and the alternate payee must provide adequate information for a quadro payment to progress successfully. Hardship distribution. A hardship distribution is an emergency removal of funds from a retirement plan in response to the IRS's terms of an immediate and heavy financial need. These types of special distributions may be permitted without penalty from such plans, such as an IRA or a qualified plan, provided that the withdrawal meets certain criteria regarding the need for funds and the amount. Plan participants must be able to prove financial need before a hardship distribution can be approved. The IRS has provided guidelines on what qualifies as a hardship distribution that include educational expenses, eviction or foreclosure, funeral expenses, unreimbursed medical expenses, the purchase or repair of a principal residence, or expenses or losses incurred on account of a natural disaster. Plan sponsors should keep in mind that you should be able to prove that a hardship exists should you be asked for supporting documentation. Loan requests. Retirement plans may, but are not required to allow loans to participants. Plan sponsors that choose to permit loans must specify the loan procedures for applying for a loan and the terms of a loan through the loan policy to the plan participants. Plan sponsors are also responsible for withholding loan repayments from participants through payroll deduction for loans that are approved and are required to remit those payments into the plan's trust in a timely manner. A plan's loan policy will dictate the availability of loans, any limit, the number of loans allowed, if there is a minimum or a maximum amount, and the interest rate that is to be repaid by the participant. In addition, a loan policy will state what will happen to that loan when a participant terminates, if that loan can be rolled over to another qualified plan, or if a loan can be renegotiated. Typically, the quickest way for a participant to access the money from their retirement account is to go directly to the record keeper that is holding the plan asset. Post-COVID, most of the asset custodians have opened up online portals for participants to request withdrawals. In the event that the asset custodian does not have online access, participants should either be referred to the record keeper directly to initiate a request online over the phone, I apologize, or they can go to you all as the plan sponsor, who can then come to Definiti to request processing procedures, whether a form is needed or a website support or calling into an 800 number. Plan sponsors should always be the point of contact for any pooled or self-directed brokerage requests that need to be initiated. Again, Definiti can provide the paperwork for those types of withdrawals. You should contact your plan consultant should you have any questions regarding the types of withdrawals allowed in your plan. If you want to add any additional types of withdrawals, or if you need specific direction on making a request.
See, thank you, Anna. Yeah, we've gotten a few questions, but before I get to those, I knew people would be curious about how does this whole loan and distribution process work. But I just want to talk about the available resources. Obviously, the session is being recorded and will be posted later next week, and we'll share an email with everyone who's registered so that you can find that. And then Anna talked about the legislation for RMDs, and that may come along with Secure 2.0. We've produced an ERISA connection just recently that talks specifically about that, and it's something we'll be watching, right, Anna? As that goes through, we'll be making sure that we watch for what changes might be coming in that legislation and share that with you. So Anna, we do have a few questions. Are you up for it?
Sure.
All right, awesome. Are all withdrawals, now this, you talked about this, but I think we want to go back and talk about it. Someone is asking, are all withdrawal requests done on paper? And is there a way for plan sponsors to allow Definiti to process or approve these requests? You've talked about requests coming in on paper, and if they do, you guys will translate, you'll put them into electronic requests, right?
Sure, if the asset custodian has that as an available feature. So I would absolutely say that it is dependent on where your plan's assets are held, on whether an electronic request can be submitted or not. The second part of that question, remind me what the second part of that question was, Elke?
And does Definiti approve or process these requests?
So we are typically the reviewer of the request. Typically, the plan sponsor is the final approver of all withdrawals. If you are interested in talking about 316 services, which was a presentation earlier in the week by Leslie Draper, we can take on that approval authority as long as we are designated as the 316 administrator on the plan.
Yeah, that's a great point. If it's something that you want to delegate, talk to Definiti, because the fiduciary studio could help you with that. Here's a question about RMDs. Does the employed employee over the RMD age have to take an RMD, or are they prohibited from taking the RMD from the 401k?
So an active employee that reaches the attained age, as long as they are not an owner, they are not required to initiate RMDs until they are no longer an active employee. So active employees that have attained age 72 are not required. Owners that have attained a required minimum age are required, and then any inactive employees that have attained that age.
Good. Okay, so I think that takes care of the two questions we had. So thank you so much, Anna. I'll pause just a moment and make sure everybody's had a chance. Thank you, Anna, for sharing your time and energy today, telling us about loans and distributions. We really appreciate it. Looks like that does satisfy the question. So thanks for your time today. Appreciate it.
Thank you.
So with the conclusion of Anna's presentation on loans and distributions, that means that we are done with our sessions for today. Once again, I want to say thanks to our sponsors for helping us with this event, and we certainly hope, I personally hope, that you are learning a lot during these sessions, and that you're able to take it back to your teams and share with them, and also encourage you to follow up with your retirement plan consultant with any additional questions that you might have about the material that we've shared today. So tune in tomorrow, where we will talk about the 401k 101 is a year in the life of a plan, where we'll actually look at the calendar. What do you need to do during each time of the year? And then also we're going to transition. I'm actually we're going to talk about bought or sold. That'll be the other presentation that we talk about M&As. So mergers and acquisitions. If you're contemplating the acquisition of a company, or your company has been acquired, what does that do for your plan? So tune in tomorrow. Join us for the 4th day of the Definiti Retirement Academy, and class dismissed. We'll see you tomorrow. Thanks, everybody.